Hello everyone, how are we doing? Welcome to a new TradendTravel video. In this video we are going to focus on what comes to learning a new language we must learn to speak. And this new language is the Japanese candles, which is the language of the financial markets. If we learn to interpret or speak this language and obtain the ability to read the charts, we will understand what the markets are telling us and we will make the right decisions at the right time. And as I always say, the most important thing is to know the psychology involved in the Japanese candle methodology. This will completely change your trading psychology forever. As with many things, you must take the time to understand all the concepts. You should take notes and always review the strategies again. To better understand Japanese candles, we must take into account certain aspects. The anatomy of Japanese candlesticks, the Japanese candlestick patterns, market structure, time frames and top-down analysis, trading strategies and tactics. Let's talk about the anatomy of Japanese candlesticks. In the anatomy of Japanese candlesticks, we must understand that candles have different body sizes and a psychology behind them. Now, Japanese candlestick patterns. Japanese candlestick patterns are an integral part of technical analysis. They emerge through human actions and reactions that are shown in patterns and constantly repeat in the charts. I want to repeat this once more, and it is important to understand the psychology behind their formation and what they indicate when they are formed in the charts. Timeframes and top-down analysis. Multi-timeframe analysis can help you see the markets very clearly and can make you a very profitable trader. Trading strategies and tactics. Of course, there are many strategies, but we are going to simplify this in the best way and we are going to make it very practical. It is not about complicating things. Rather, it is about doing this activity in the best way, very relaxed, with the best psychology and very sure of the strategies. In TradendTravel, we are going to teach you some price action strategies with candlesticks like pin bar strategies, engulfing bar strategies, strategies with hammers, strategies with tweezers, strategies with haramis, and strategies with candlesticks with false breakouts. I recommend mastering the previous sections before jumping to the next section, because if you don't master the basics, you won't be ready to use these strategies as effective as they should be. In this section you will learn how to identify high probability setups in the markets. You are going to learn how to use candlestick patterns when the markets are trending and also when the markets are in range to maximize profits. Risk and capital management. Of course, you got to learn how to control your risk in order to protect your capital. Remember that you must learn to be consistently profitable. So now let's talk about history. It is important that we talk a bit of history about Japanese candlesticks. Japanese candlesticks have been around much earlier or longer than anything similar in the Western world. The Japanese watched charts, graphics or cards from the 17th century, while the first known chart in the United States appeared in the late 19th century. Rice trading had been established in Japan in 1654 with gold, silver and rapeseed oil shortly thereafter. Rice markets dominated Japan back then, and goods or commodities apparently became more important than any currency. Munehisa Honma, aka Sokyu Honma, a rice trader born in the early 1700s, is widely recognized as one of the earliest exponents of price action followers. He understood the basic dynamics of supply and demand, but also identified the fact that emotion played an important role in pricing. He wanted to follow the excitement of the market players, and this work became the basis of the Japanese Candlesticks. He was so respected to the point of being promoted to samurai status. The Japanese did a very good job of keeping Japanese candlesticks silent and secret from the Western world until 1980, when suddenly there was a huge growth in crossings or exchanges of banks and financial institutions around the world. That's how Westerners suddenly found out about these mystical cards. Obviously, this was about the time when graphics suddenly became easier given the widespread use of the PC. In the late 1980s, many Western analysts became interested in candlesticks. In the United Kingdom, Michael Finney, who was then the head of TA in London for Sumitomo, began to use Japanese candlesticks in his daily work and began to introduce these ideas to professionals in London. In December 1989, in an issue of Futures magazine, Steve Neeson, who was a technical analyst at Merrill Lynch in New York, he created a document showing series of reversal patterns and explained its predictive powers. Then wrote a book on the subject. Now let's go back to the technicals and why candlesticks are important for our technical analysis. We already know that Japanese candlesticks are a visual representation of what's happening in the market. We can get valuable information about the open, high, low, and closing of the price, which will give us an idea about the price action. Candlesticks are flexible. They can be used alone or in combination with technical analysis or tools such as moving averages or momentum oscillators. They can also be used with methods such as the Dawes theory and Elliott's wave theory. Candlesticks can be used mainly with supports and resistances, trend lines, and other technical tools that we will discover in the following chapters and videos. Human behavior in relation to money is always dominated by fear, greed, and hope. Remember what we had talked in the previous video about psychology and consistency in trading. In trading, there is no hope. We must respect our analysis and just trade without emotions. Japanese candlestick analysis will help you understand these changing psychological factors and will show you how buyers and sellers interact with each other. Japanese candles provide more valuable information than bar charts. Using them is a winning situation because you can get all the trading signals clearly. Japanese candles are used by the best professional traders, banks, and investment funds or hedge funds. They trade millions of dollars every day and can move the markets whenever they want. Using Japanese candlesticks will help you when to go in or when to go out and when to stay away from the markets. And how these Japanese candlesticks are formed. They are formed by an open, a high, a low, and a close. Since we have talked about how candles are formed, then we are going to talk about some of them and their patterns. Engulfing candlestick patterns, doji, dragonfly doji, gravestone doji, morning star, evening star, hammer, pin bar, shooting star, harami, tweezers. Engulfing candlestick pattern. The engulfing pattern is formed when one candle grabs or engulfs the previous candle or candles. Once this candle wraps one candle or more of the previous ones, we can consider an engulfing pattern. Remember that there are bullish and bearish engulfing patterns. The engulfing patterns are very important because they indicate power or strength in price. Remember that all these patterns are very important if we find them at key price levels or zones. And I mean at key levels of supports and resistances. Do not forget that supports are floors and resistances are ceilings. Or if you want to talk more technically, supports are minimums and resistances are maximums in price. Now let's talk about dojis. Dojis are candles of equality or indecision. Listen, basically dojis don't give us a directional signal, but giving a combination of this candle with a following strength candle at a key price action level can give us a very strong entry signal. Dojis can often be found during rest periods after huge higher or lower moves. When they are at the end or the top of a trend, it can be considered as a signal that the previous trend could be losing strength. If you are already in that trend, it is time to take profits. And as I said before, it can be used as an entry signal combined with other technical analysis and more confirmations. Now let's move on and talk about the Dragonfly Doji. The Dragonfly Doji is found particularly in key support levels, and what characterizes it is the large wicks that shows the bulls or buyers in their attempt to change direction or push the market up. One of the important things in global markets is that if we find huge rejection candles, they can give us a very strong entry signal. If you identify this candle pattern in the chart, it will help you see when and where to spot key areas of support or demand. The formation of the Dragonfly Doji with the lower long wick shows you a strong bullish pressure in the zone. When it occurs in a downtrend, it is interpreted as a bullish signal reversal. Obviously, we will always need other tools to determine high probability signals with the Dragonfly Doji in the markets. This means that we must always look for more confirmations. So let's move on now to the Gravestone Doji. The Gravestone Doji is the bearish version of the Dragonfly Doji. What sets it apart from the Dragonfly Doji is the superior long wick. The formation of the upper long wick is an indication that the market is testing a powerful area of supply or resistance. The formation of this candlestick pattern indicates that bulls or buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. Let's talk about the Morningstar. The Morningstar is considered a bullish pattern of change, often can be seen at the end of a downtrend, and this consists of 3 candles. The first candle is bearish, which indicates that the bears or sellers are still in control of the market. The second candle is small. It tells us that the bears are in control, but they don't push the market lower, and this candle can be bullish or bearish. The third candle is bullish and has a lot of strength. It could be a signal of trend reversal. Basically, the Morningstar is found in key levels of support or demand areas. The Evening Star. The Evening Star is the bearish version of the Morningstar and is obviously very important if it is found at a key level of resistance. Hammer or pin bar. Its characteristic is a long wick indicating bullish rejection by the bulls and their intention to push the market higher. The hammer is a pattern of reversal when it happens at the end of a downtrend. We must be clear that the hammer is a pin bar, and generally, when we find these pin bars at key levels, they give us very strong entry signals. The Shooting Star. The Shooting Star has a small body and a long superior wick. The longer the top wick, the stronger our entry signal will be. When this happens in an uptrend, it can be a signal of reversal. Harami. The Harami pattern, or pregnant in Japanese, is considered a pattern of reversal and continuation. And why is it called pregnant in Japanese? Simply because the first candle is long and is called the mother candle, and the next candle is smaller. It's called the baby candle. This pattern can be both bullish and bearish if we find it at key levels of support and resistance. But if we find this pattern during a bullish or bearish trend, it is interpreted as a continuation pattern, which gives us a good opportunity to join the trend. So finally, tweezers. This pattern can be bullish or bearish if we find it at significant zones of supply or demand or levels of support and resistance. So now your job is to identify these patterns in any chart and any market you are trading. Remember that you must simplify everything you learn, and remember that with patience, constancy and consistency you will be able to achieve lots of profitability if you find all these patterns in key levels of support and resistances or areas of supply and demand. Don't make it complicated. Always follow a plan. Always trade without emotions and learn to execute your trades. And don't forget to always check this video every time you need it. So if you feel like you have learned from this video, like this video, share and leave your comments. Don't forget to subscribe to this channel and activate the bell button to get all the notifications of every educational videos we will be posting so you can improve your trading. If you also want to receive more news about the financial world and other alternatives to monetize or capitalize, you already know what you should do. Just subscribe and activate the bell button.